Unstoppable. Relentless. It's the ironclad investment discipline.
How to reduce the taxes that you pay on your investment income. In this short video, I'm going to be talking about something that I call asset location, not to be confused with asset allocation. Asset allocation, common term in the investment business, how much of your money should be in stocks, how much should be in bonds. Today I'm going to be talking about asset location, which is where do you physically hold your various securities or investments to help you minimize your tax. And before I do, just a brief tutorial on the three forms of taxation that result from your investments. Number one is if you have interest income on bonds, you're going to get a T-slip and you're going to have to report 100% of any interest income that you earn from bonds on your taxable income each year. And you're going to pay tax, and if you're in Ontario, if you're in the high marginal tax rate, you're going to pay 53.5% tax on the interest income earned if you hold those investments in a taxable account. Then you have capital gains. So you sell a stock at a higher price than what you paid for it, or a stock mutual fund or a stock ETF, and you have to add half of that gain to your taxable income the year that you sell it. So said another way, capital gains are taxed at half the rate that interest income is taxed. And then there's dividend income that you get on stocks and certain securities. You get a dividend tax credit. You're taxed on that dividend income, but you get a corresponding tax credit here in Canada. It can be a bit of a convoluted computation. Let's just leave it at this. Interest income taxed the most at the highest level, then dividend income, and then capital gains taxed the most favorably. So the opportunity is to hold your interest-paying securities in registered accounts where there is no tax. So here in Canada, that would be in a RSP, a RIF, or a tax-free savings account. For my American clients, it would be in a 401k or an IRA. And so there is no report of buildup. So even if you earn interest income inside of those accounts, no tax. And then hold your taxable, so much as possible, hold your stocks in your taxable account. So I think an example will illustrate this nicely. Say you have $1 million investment portfolio and you got $500,000 of RSPs and 401ks and $500,000 of taxable investments. Let's assume you've got a 50-50 stock bond mix. You got $1 million portfolio, half in stocks, half in bonds. Well, you should hold the $500,000 that you have in bonds in your registered account, RSP and 401k. So if the bonds were paying 5% of 500,000 is $25,000 of interest income. If you hold that in a taxable account, you're going to pay tax. If you're in the punishing 53.5% tax rate here in Ontario, you're going to pay about $13,000 in tax if you hold those bonds in a taxable account. Instead, if you hold the $500,000 of stocks in the taxable account and hold the $500,000 of bonds in the RSP, you're going to avoid that $13,000 of tax each and every year. So we're not talking about a small tax savings. Yet most people, when they come to me, I would say this would be in the top 5 mistakes that I see people make. Almost invariably, I find that people are holding stocks in their RSPs and bonds in their taxable account when it should be the exact opposite. And if you're one of these people that has your money spread all over the place, forget it. I guarantee you're not tax efficient. The left side doesn't know what the right side's doing. There's no way that you're going to have your money tax efficient if you've got money spread all over the place. And so, look, without getting too political, I'm of the opinion, and then I'm going to set my opinion aside for a second. I'm of the opinion that high income earners in this country and in America pay a vastly unfair or unproportionate amount of taxes in both countries. Whether you agree or disagree with that, probably in large degree depends on your own personal situation. But I think there's one thing that we can agree on, and that is it would be a missed opportunity to not do everything in your power to minimize your tax bill. And one way you can do that legally is asset location, being strategic about where you hold your various securities. But most advisors don't do this. Most of my colleagues don't do this. It's a lot of work. We manage hundreds of millions of dollars on behalf of our clients. They have RSPs, 401ks, tax-free savings accounts, holding companies, taxable accounts. We're rebalancing their portfolio every quarter to get back to whatever their desired asset mix is. Now we got to add one more layer of complexity to the whole thing, which is where are we going to locate various securities? Where are we going to hold them to help them minimize tax? But I believe that that's in my client's best interest, which is why we do it. And most people, I don't know if it's laziness or maybe they're just not wired that way. It is a lot of work, but I believe that the benefits of it are worth the amount of work. So you may have read in some of my marketing material that one of my taglines is to make your money work as hard for you as you did for it. Really, that's not some willy-nilly thing that we came up with. That's who I am for my clients, and that discipline, that ironclad discipline that we use for the investments, we also use when it comes to minimizing taxes. So if you're a client, hopefully this reassures you some of the things that we've talked about, or if we haven't spoken about it, that we're doing that behind the scenes. And if you're not a client and you'd like to talk about your situation to make sure that you're being tax efficient and not paying unnecessary tax, I'd love the opportunity to sit down with you. In the meantime, I hope this has been useful, and I appreciate your viewership.